video, we're going to go over how you can cover yourself in investments and pretty much own everything there is to own in the world through stocks, ETFs, and crypto. So we're going to get right into it. I get this question all the time is, what should I be buying? What should I be investing in? And these are typically from people who don't have a financial advisor or have never invested before. And so this is going to be our intro using Public. I don't really use Public that much, but I do like their website. I've just been throwing a few dollars in here over the past couple months, and I haven't invested anything. I bought like an option contract I had from some money they gave me when I first joined. But um, let's set up an all-weather portfolio that this would be very important. Like this should be like if you're 18, you're 20, you're 30, 40, it doesn't matter how old you are. If you're going to start investing, you need to have an absolute dialed in strategy and you need to be consistent. You can't say, oh, one day I'm just going to go buy a bunch of Tesla stock and all that. You need to have your basis set first, which would be some portion of your income that is automated. The trick here is to automate your investments to where you don't have to do it and it happens automatically. So let's just say you, here, let's open a calculator. Let's say you have, yeah, let's get back to this. Do it over here. Let's just say, your biweekly income is 2,500 bucks. And so your goal should be able to save the highest percentage of money that you can from your paycheck while still living, a lifestyle that isn't, completely like hoard and rugged, right? And so, what I'd like to do is I'd like to save 40%. So every time I get paid, when I deposit my money, I just multiply whatever I deposit by point 0.4, and that's 40%. And so that's the amount that I will save and invest. On typically a weekly basis, but let's just assume your paycheck is every 2 weeks. And so, like once I have this thousand, I will split it up into three categories. And so I'll do $333. I'll put that into cash and bonds so I can have reserves to when markets do correct. The other part will go into, stocks and ETF. And then I am big on Bitcoin, and I think, it's just schmuck insurance against our politicians and our government just spending money radically. So it's I see that as an inflation hedge and a potentially a hedge against the demise of the dollar, which is currently happening and has been happening since 2008. So I would put $330 into Bitcoin, the other ones into my stocks and ETFs, and then the other ones into cash reserves, to either buy real estate, if there's a crazy dip, or if there's a buying opportunity of some sort of stocks or crypto or something, then I have reserves to fall back on. So either way, find out what your percentage is. So, if you make 1,200 every 2 weeks, are you able to save, 20%? So you just multiply it by point 0.2. So that means you 240 bucks. And that doesn't sound like a lot at first, but if you are consistent and you automate this, this can grow, especially in a year, 2 years, 3 years, if the market is doing well. And even if it's doing bad, if the market is doing bad, it's actually better for you if you're younger because you're getting a cheaper price. But you have to be diversified because it could take, the US market could do poorly for 10, 20 years. Who knows? Like we've been blessed the past 20 years, but that could easily change. So either way, let's jump over to how we would even build this. So let's start with IBV. So this is 500 or the S&P 500, so the top 500 companies in the US. And the popular ETF is called SPY. This is the same ETF, but it's got a higher expense ratio. So this is something you really want to look at whenever you're buying an ETF is your expense ratio. This is how much it costs you to own the ETF. And so they take this fee out on a yearly basis. They probably take it every quarter, but that's 0.09. And so we can see their holdings. So they're holding NVIDIA, Apple, Microsoft, Amazon, Google, Broadcom, Alphabet, all of these guys are in this ETF. And so the reason why I like IVV is because of the expense ratio. Um, so, you can see it's the same thing, costs the same amount of dollars, assets damn near identical, probably the same weightings also, because it probably tracks the S&P, but the expense ratio is half or 1/3. I can't remember if that was what SPY was, but there you go. It's a cheaper expense ratio. So we like that. We want to save as much money as possible to fees. And so what I would do is set a recurring investment plan. And so you can see this is already in here, and we will weight these. I think Public will allow us to weight these. And so let's add our next one. I'm going to go Bitcoin. So again, this is Schmuck Insurance um, against our politicians, and it's a great inflation hedge, and it's the best performing asset there's been in the last 20 years. So no matter what you think about Bitcoin, it has performed the best. I bought it when it was at 7,000, and it went to 126,000 over the actually yeah, 126,000 over the last 4 years, 5 years. So um, it speaks for itself. So if you're skeptical of it, then you can reduce this. You can put this down to 5%, right? Whatever you feel comfortable doing. I personally want 20%. I think with the way things are going, the demise of the dollar, the fact that our government could not stop printing money and spending money and sending money to foreign nations and whatnot, that it is a insurance that is necessary in your portfolio. So let's do our core, our S&P 500. We're going to put that at 45%. And then let's add, so we're going to do VXUS. So this is Vanguard's total international stocks. So we're going to put this at 15%, and then we'll go over what's in here. Let's go over this. VXUS. So these are all international stocks. So we already have America's top 500, so we're secure there. Now let's broaden it out and let's grab like ASML. This is huge for semiconductors, one of the most important companies in the world. But I believe it's in New Zealand or one of those other countries where, we can't buy this individual stock on the stock market as Americans. So AstraZeneca, healthcare company, Novan, Shell, Royal Bank of Canada. So you just have these other companies here that we don't have access to as Americans. And so this gives you a little bit of diversity. Say the American stock market's not doing well, the American economy's in a downturn, but the rest of the world's doing well. And so you actually get a dividend rate on this. So you will get paid $2.29 every $100 you have in the fund a year. So they'll probably pay these quarterly or biannually. Um, and your expense ratio is super low. It's 0.05. So this is a pretty solid fund in my opinion. This gives you some exposure, and you can see over the past year it's up 23%. 5 years probably about as similar, but if you were buying in October 20 down in the 45s and you were buying every 2 weeks, like you're picking up shares on the cheap, and you're getting paid a dividend, and you doubled your money right here because you were probably buying at 45 and it's at 84 right now. So pretty close to a double plus your dividends. There you go. Let's go back to our recurring investment plan. Um, so hold on, we'll go back to our IVV because that's where we had this originally started. I haven't used Public a whole lot. I honestly just been throwing a little bit of money in here just because I like the way that the platform looks. I think it's super clean. Um, and then let's go over another one we're going to add. We're going to do SCHD. So this is Schwab's US Dividend ETF. So this one's actually done pretty well over the year too. It's up 21%. Um, expense ratio is pretty reasonable, 0.06, and the dividend rate is 3.27%. So this is something that is going to pay you. So here, the SGAD tracks a market cap weighted index of 100 dividend paying U.S. equities. So this is going to give you a little bit of stability and a little bit of cash flow, even if stocks are doing bad. This is something that is going to pay you on the regular. And so you can see it's got Texas Instruments, United Health, Qualcomm, Coca-Cola, Chevron, Merck, Procter, Conoco, Amgen, Verizon. And the reason why ETFs are great is because if you want to buy dividend stocks, you're going to go buy Texas Instruments on its own or Coca-Cola on its own, but this can help you avoid big drawdowns from, say, Coca-Cola has some sort of, recall on their products or something like that, and the stock drops, 20, 30%. And you're just there to collect the dividend, but your overall principal, say you invested 10,000 bucks and it drops 20% a day, you lost 2 grand. Is that really worth your dividend yield at that point? So holding a basket of them helps you protect your downside a bit. Um, so that's why I kind of like it. It's a no-brainer. You don't have to think about it. You can just put this on auto buy. So either way, it's up 21% on the year, which is pretty crazy. Typically, your dividends are going to kind of be more steady. Um, and just drip in your dividend amount, meaning whenever they pay you out, it just gets reinvested back into the ETF and it continues to compound. Last one, we're going to do BND. So this is Vanguard's bond market. And so, bonds have been doing really horribly over the past several years, actually. Um, since 2021 when really the market started doing really well. But looking at this, I kind of see this formation where it looks like these have been accumulating, meaning people like there's some sort of support around these areas. And so with the stock market all-time highs, typically bonds and stocks are supposed to correlate inversely. They're supposed to move inversely. So when stocks go up, bonds go down. When bonds go up, stocks go down. Either way, with the market at all-time highs and with the way the market has performed over the past, since 2008, really, I think bonds are really overlooked. So I think there's definitely, no matter your age, I think that you should have a little bit in here in case we do go into like a market turmoil. This can really provide you some stability. You get a dividend rate, you get 3.98%. So you're going to get paid $2.09 or $2.90 for every 100 bucks you have in there. And your expense ratio is hardly nothing. It's 0.03. And so we will add this to the fund. Okay, so let's build our percentages on this. Go back to IVV. And we'll go to create a recurring investment plan. We got IVV in there. We're going to add our Bitcoin. Okay, we got Bitcoin in there. Let's do our international stocks, VXUS, and then let's do our dividends. A little bit more stability. We'll buy our Coca-Colas and all that, and then our B&D, which is going to be our bonds. Okay, so 45%. This is pretty high, right? Because you're exposed to the U.S. stock market quite a bit. So if this goes down, a lot of your portfolio is going to go down, but don't bet against America. It's been doing well for a long time. And if it does do poorly over the next decade, it's probably a good buying opportunity. So 15% here for the international. We're going to go 15% on our Schwab dividend, and then we're going to go 5% on our bonds. And so we have 100% allocation here. So you own between IVV and VXUS, you own pretty much every important US company and international company in the world. So you pretty much own the whole stock market at this point of the world. Now, your crypto here, you have Schmuck Insurance, and this is 20%. It's the best performing asset of the decade. I think it's going to continue to go down. I think it'll go into the 40s. Potentially, I think it can go into the 30K, 20Ks if things get really rough with, the stock markets and the international geopolitical issues that are occurring right now. However, there is some merit to what Bitcoin can do. The technology's there. The way AI is moving, they're going to need valid proof of transactions occurring and information assurance. And there's no better way to do it than blockchain. And so once you have this set, you figure out how much you can take out of your income, whenever you get paid, and then you automate this. So you automate this into recurring buys, and you can adjust these percentages however you want. But when you have these, again, you have every important stock in the whole world with these two. You have crypto exposure, which is going to benefit from AI and the agents and everything else going on there. Say all stocks are doing poorly, you have some SCHD, which you are building dividends. So you have Coca-Cola paying you regularly from their profits, and the healthcare companies and everything else that's in the SCHD. So you can have a little bit of support there. Your bonds, again, if the stocks start doing poorly, people are going to pile into bonds. So your bonds could actually see a rally. I wouldn't be surprised to see bonds do have a little bit of trouble here coming into our geopolitical conflicts, but I think bonds are being overlooked. And so once you have this secured, like you're set, you could let this go on repeat for the next 10, 20, 30, 40 years, and you will probably do really well. Like this will probably do really well. You wouldn't have to touch it. And that's the strategy. You want to not have to touch this at all and set your calculation um, of whatever income that you can put aside for this. And then, once you have this set and it's automated, then you can take your extra bonuses or your extra 5% or 10% you have from your paychecks, and you can start buying individual stocks, individual cryptos, but let this run its course. Let this stay solid. And once you have this, then you can venture out and you can start saving more for, if you want to buy a duplex or a quadplex or some sort of real estate. You want to buy Ethereum, which I think Ethereum is probably highly overlooked right now, even though it is at a high valuation. Um, I think Ethereum gets a lot of hate, but there's tons of stuff that is built on this protocol. And so this is another crypto that you can look at. But crypto's been in a rough spot recently. So either way, This is the foolproof portfolio that you can set up, automate, and then once you have this set, you can venture out, let this cook, and start buying. If you see the next Tesla or the Ethereums, you can speculate a little bit more on those things, but do not touch your recurrings. Let this build and let it work its magic for you. The biggest mistake you can make is interrupting the compound interest on this. So that's all I've got. I will also leave in the description, I'll leave a link to public if you want to use this site. I think Robinhood's really good. I'll leave a link to my Robinhood sign up where if you guys sign up, you'll get free stock. I'll get free stock. And then Coinbase. So Coinbase is a crypto platform. So you can buy your Bitcoin, your Ethereum. You're going to get a better fill, meaning you're going to get a better price on your cryptos if you buy through Coinbase typically, because that's what they specialize in. So I'll leave all three of those in the link below. We'll both get rewards if you end up signing up and implementing a strategy to help protect your uh, your financial future. So again, the markets are volatile. We're in the middle of tons of international crises. So the stock market's going to be up and down all over the place over the next 2, 3, 4 years, I would imagine. And I would be raising a lot of cash right now. um, so say you want to invest 20% of your income, I probably save the other 20% and then use the other 60 for your expenses and your housing. But I would really try to cut any subscriptions you have, probably start trying to eat out less. And I think things are probably going to get pretty rough. But when the stocks are down and the cryptos are down, it's probably a good time to start accumulating, because the demise of the dollar is they can't stop printing it. So you need to have some sort of outlet. So that's all I've got. If you have any questions, leave them in the comments, and then check out my links below if you want to sign up for Public, Robinhood, or Coinbase. Thanks.